Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. It is October 7th, and this is the public live stream for my YouTube channel. Welcome. Remember, everything I talk about here is not financial advice in any way, shape, or form. It's just what I'm looking at, what I'm doing. I'm not a professional trader. I've just been trading for a very long time. I started trading in 1996. Can you believe it or not? That is a long time now. 29 years I've been at this. I still love it. I still get at the computer every day. I see Kevin's online. Awesome to see you as always, Kevin. Thank you so much for joining and thanks for the likes. Anybody else joining, please let me know where you're watching from. My public streams are pretty fun. What we do is we just get on, we take a look at what is going on in the market, and then I just come up with trades. Now I'm a range trader, so that's what I like to do. I generally trade fairly delta neutral. So what I'm looking for is I'm looking for plays that I can make money whether or not the stock goes up or the stock goes down. And I try to make money off of daily decay without taking too much risk. So I do lots of defined risk trades, and I use options to do that. So if you're new to the channel, remember to give me a like, hit the subscribe button, and make sure you turn on all your notifications so that you make sure that you don't miss these Tuesday streams. I stream Tuesdays at 11 p.m. Pacific or 2 p.m. Eastern Standard Time. So it's during market hours. And part of the reason I do that is because that way I have the absolute freshest data available. And so we can look at these trades together. I see Dennis is online. Good afternoon, Dennis. I hope you got your spreadsheet things sorted out. I didn't hear back from you in the Discord, but appreciate you guys as always. I do have a link down in the description for the Discord as well. If you're interested, you can sign up. There's free posts that you can make, and you can see some of the stuff that I do. Obviously, I have my paid membership as well, and that's for people that are interested in having a little bit more to do with what's going on in the chat room. So we see the trades that I'm putting on. Today has been an extremely busy day. I don't even know how many trades I put on so far today. In the options, put on, I don't even know. It's let me look here. I've got the busy couple of days actually. So this morning, what did I do? I did a couple of adjustments, but new trades. I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 new trades just today. Now I typically only try to put on 10 trades a week. And so it's pretty unusual for me to cluster so many, but there was lots of opportunity today. So we're going to take a look and see what's going on in the SPX, and we'll see why I thought there might be some opportunity here. If we look at the S&P 500, I've got a whole bunch of lines going on here, don't I? S&P 500, I've got something on here, some sort of comparison in here. Let me just drop this. Let me just drop the NASDAQ comparison on there. What is going on? SPX is down 0.53%. And why is this exciting for me? I mean, I'm looking for opportunity to place trades. We don't know what's going on with the market. We never do. You know, from this point, it could go up, it could go down. The reason that I like to do this is because the VIX spiked a little bit. Now, this is not a big spike. You can see here's the VIX level, and this red line is the average VIX, but we're slightly above average. So what I do with those in those times is I like to sell premium, and that gives me opportunity. So the SPX being down 0.5% gives me a slight advantage to opening new trades that have a credit for selling premium. NASDAQ is dropping, but it's also just very much in this tight range. No, the drop is no bigger or smaller than the previous day. You can see we're having a little bit of consolidation happening. In these last couple of days, we had a small green candle to the upside and a small red candle the same size. Then we had a slightly larger green candle, and then we had a slightly or the same size red candle as the previous day. Now, one thing to note is that the volume is slowly dropping. So we don't like to see this. When the volume is dropping, especially when we're at all-time highs, this could be an indicator that we can see a bigger drop down. And of course, we don't really know. Now, the Russell, a bigger move today than the other ones, with down 1.28%. And this is where I was looking for opportunity in some of the small caps, because when I do that, what I'm doing is I'm looking for a potential trade where I don't have any upside risk. What happens if these stocks go up? And there's lots of stocks down today. Dow Jones Industrial average down 0.42%, but everything's still very much at the top of its typical, or not atypical range, I guess. I've got this little oil play in here. I have this custom indicator that I downloaded, and it's actually showing, it's pretty interesting. It's showing that a Bollinger Band sell here, this little red line was showing a sell, which would have sucked on this up move, but overall would have been good. And interestingly, just signaled a buy yesterday. So this some little indicator that I have. I don't actually track it, but it is kind of interesting to see some of these custom indicators that people have published on the internet when we run them, where it actually is showing there might be a pivot point. So that was kind of interesting. My range on this is between 64 and 60. That's my ideal. My max profit is actually between 63 and 58, but that was the target range for entry for this trade. And I've got 9 days left, and right now it's couldn't be better. I'm loving that trade. Gold up today, hitting all-time highs. The question is, should we be shorting gold or not when we see this outside of this range? Dennis is asking, when you roll in the money calls, please explain what you mean by gaining an extrinsic value decay each week. Absolutely, we'll take a look at that. So we'll take a look at what I mean by that specifically. And silver, same sort of thing. We're outside of this range to the top, and we've got a range to the bottom. So where would I play this? I would play this so that my expected move would make money if it came back down into this range. Now for silver, I just play SILJ. So if we were to take a position, what I would do is I would build a profit tent that kind of made max profit if we fell down into it, with no upside risk on the metals right now, because it's been a parabolic year and this could continue. So I'm not looking for additional upside risk on most of my positions. Okay, let's take a look at a couple stocks here. We've got Apple at the top of its range, ARK-K pushing outside of its range, Adobe still down at the bottom. We'll see what happens. I would love to see it move up. Amazon, this has been a nice little play that I've got on, made quite a bit of money today on that, which is nice. Chewy's trading at 37.38, so it's in the middle of its Bollinger Bands. Hood continues to be at the top side of its range, so I would be playing that slightly short, but not massively so. Google, I might have a little bit of downside movement on that, and Meta trading near the middle of its range. Lots of consolidation, lots of volume in these areas, picking up some volume on some of these down days. So this could be poised for a breakout to the upside if that were to happen, if there was some good news there. Microsoft in its range, normal, just slightly below average volume on there. MicroStrategy down today. What is Bitcoin doing? Do I have Bitcoin on here? Yeah, so when we see MicroStrategy down 7.8%, this usually correlates to Bitcoin prices, and we can see the Bitcoin down to 2.8% today. So just interesting. Here's a good example of where this custom indicator is actually working quite well. So showing these sell signals, buy, sell, and repeatedly working. Like this is a pretty interesting. This is why I keep these custom indicators on, because they're kind of fun. Like these were all wins. That's like a sell, long, short, long, short, long, and you can see it just appeared here going short just 1-2 days ago, and we're on the daily chart now. If I go, let me just go to the 3-hour chart. Does it show up on here still? Yeah, so it does. So there's a few more time frames, and depending on what we're looking at, but telling us long, short, long, short. This short would have been terrible. Actually, no, and it depends, I guess, where they are. So if this was long, short, that's a win. This is a long, and a short, that's a loss. A long and a stop out, long and a short, long and a short, those are wins. This is a win, and then currently sitting in no position. Yeah, pretty interesting to do on the 4-hour chart. And obviously these work better on certain charts. I would probably do it on the daily, but these these have all been wins. That's a win. That's a win. A win. A win. And a win. Pretty great. Pretty great little indicator. So things to check out. What's that one called? Bollinger Band strategy. Let me just turn that on and make sure that it's on and off. Hide it here. Yeah, that's what it is. So far, doing pretty well. I don't know what I just did there. Clicked on something. There we go. Okay. Let's take a look at Moomoo and take a look at what is going on. I've got some nice little positions on right now. Just give me 1 second. We'll get this loaded up here. And Pony coming down 21.49. We've got down. This is one of the AI stocks down 8% today. That's one of the things I was looking at. Now, specifically, I'm going to look at Mera. Now, Mera is one of the stocks that is an incredibly good payer for me. It has been fantastic. And I play a very simple trade on it. What I do is I trade a covered call strategy on it, which is dead simple. So what I do is I am selling a short put, or a short call rather. And if we can get this open, I want to add, let's just do, let's do a covered stock position. So let's pretend that we're opening it today. Let's look at the curve. And there we go. So this might be a position that somebody could hold. And what we're doing with this is we are purchasing. I don't know why this doesn't show up at the bottom. Not the way that I want to do this. What I want is to do a custom, and I want to see there it is. It's on my other screen. That's why it's having a problem. That's what I want. Okay, I just want to delete this row. So let's say I have this position. Sorry about that, cumbersome here. Mera buy 100 shares, October 10th, which is expiring in 3 days, the 17 call. Now, what does this look like? Let's take a look. Well, the max profit on this trade right now is $5. That's it. I got $5 in expected, and I have a max loss of $1,700. And so my break even is $16.93. It's way down here. I don't expect Mera to drop that much. Mera is trading at $20, $16.95. It's got a 94% probability of profit. But the problem is this just isn't making me money anymore. So what do I want to do with this? Well, what I want to do is I want to get myself into a better position. And a better position will mean that I can potentially make some more money, increase my chances of making money. So what if I go out to October 17th and I look at the 17 call? Now this 17 call still has a high probability trade, and the max profit is $21. Now my max loss is $16.79. What I want to do consistently with this is I want to keep a trade on, and I want to make this max profit as big as possible. So if I was to open this today, I probably wouldn't be opening a trade that has a probability of 82% with a max profit of 21. And the reason that I wouldn't do that is simple. I want to make more money than that. I'm a little bit greedy with my positions. So if I was to open up my calculator, let's find it here. Here we go. If I was to open up my calculator and we just use this value, if I make $21, and divide that by that risk of $16.79, and we divide, then this is going to be the percentage return, and we divide that by the number of days, and this is 10 days out, and then we times this by 365. This is going to give me my expected annualized return, which is 45%, which is pretty good. You know, this is why I trade Mera. You know, it consistently gives me a very, very close. I make about 40% per year trading Mera stocks, and I have for years now. So this is one of the positions that I have on right now. This would be a fine position to roll into, But what I want is to actually be a little greedier than that. So I'm going to look at what exactly I rolled into. Let me just look at my long-term, because I did post this in my Discord this morning, and I rolled into the 17.5. So I had some 17s on and I rolled them into the 17.5. And the reason I might do that is because if we change this, they're going to be a slightly higher return. If we look at this, the max profit now on this trade is $33 and the max loss is $17.17. So let's just do that math again. $33 divided by 17 equals, this is going to be my weekly return, 1.9%. We divide that by 10 and we times it by 365 to give me my annualized return. Very simple math, 70% annualized return. So if I was to roll out, if I held my Mara stocks and I rolled out to the October 17th 17 call, then I'm making a 45% return. And if I'm rolling out to the 17.5, then I'm making a 70% return on capital. That's what I'm aiming for. I'm aiming for very, very, very large returns in order to make really great returns. I want to target as high as possible. Now, it doesn't mean that I'm taking a massive amount of risk. In fact, the risk on this is still 78% likelihood of making some money. And the delta on this, does it show here? Does it show the delta? We'll go to the table. The delta on this call, the October 17th, 17.5 is, we're going to scroll over to the delta column and we're going to look at that delta. It's 82. So we have an 82% chance of making max profit. That is incredibly high. So what I do with these positions is I tend to roll them. If we were to look at the chart on Mara, what happens with the stock is that it cycles through. It goes up and down, and it replicates with Bitcoin. So we can see this kind of this curve that's happening. And what I want to do is I want to kind of play a midline. I don't want to be super, super aggressive. I don't want to be taking tons of downside potential when the stock is way up here, because we all know what can happen. We could see these indicators and we can say, hey, when the stock does this, when the stock is replicating this kind of momentum, there's a good chance that this could cross over and the stock could come down, and then I would lose. So what I want to do is I want to keep some money on the table, but I'm not super aggressive about my price. 17.5 is down here. That's where my level is. And I can mark that line on here, 17.5. That's my max profit line. Let me just put it right here. So that's my max profit line. And I'm happy to trade this the way that it is. When it is up, I do want to take a little bit of money. What I did with this position, I can show you exactly. So let's, and the reason that I do this, I'm going to delete the shares, but I do own the shares in this account. But what I did, I'm going to start from the very beginning. I purchased my covered calls that I had to close. Now I had some of them. I was buying some down here at the 17, and I was buying some at the 17.5. So let's just assume we had 1 and 1 of each. What I want to do is increase my potential profit. And I also want to take risk off the table. Risk off the table comes in the form of taking cash, converting some things back to cash. Now I could easily just go to the 17 and 17.5, and I would collect cash. I would collect 38 cents in credit. This would reduce my risk, but I would be rolling some of the positions into a position that makes a 45% return and some that make a 70% return. And what I want to do is I want to do both. I want to increase my potential and decrease my risk. And when I'm getting 38 cents, I can use some of that value to purchase a higher call strike. And so that's what I did. In this case, I didn't sell any 17s this week. For every one a pair, a 17 call that I purchased and a 17.5 call that I purchased, because I had both of those in play, I rolled them out to the October 17th 17.5 call. And when I do that, buying one and selling two, you can see I'm still getting a credit. I'm actually getting, this is showing a debit. I was actually able to get this filled for a 1 cent credit. So I have increased my potential on the trade from, instead of agreeing to sell my shares for $17, I am now agreeing to sell them for $17.50. That means I have increased the potential of the trade by $50 per 100 shares. And I have also collected $1, which covers my commissions. It's a pretty awesome way to trade. And so what I'm doing is I'm increasing the amount of extrinsic value that's available. That is what's happening. By rolling up to a position that is has greater extrinsic value, then I have increased that by that $50. I hope that makes sense. I mean, the extrinsic value is the amount of time that is left in the trade and the amount of risk that the stock could go to that price. Stock's trading at $21. It's pretty unlikely the stock's going to trade at 17 in the next couple of days. That's why there's no extrinsic value left. If we want to see exactly how much extrinsic value there is, I use a little cheat and I look at the put side. So if we look at the October 10th, how much are the 17 puts selling for? Well, they're selling for 5 cents. So that's how much extrinsic value is. There's 5 cents in the October 10th 17 calls and puts. Because the put is out of the money, it has no in the money valuation, so there's no intrinsic value, it's only extrinsic value. And because of arbitrage, the extrinsic value for both the short call and the short put is the same. So I just look at the value of the short put and then it can tell me whether or not I have that value. So let's look at the value of the 17 put, which I hope nobody's selling a 17 put expiring this week and only collecting 5 cents, because that would be a silly risk to reward. And we can see how much extrinsic value we get for selling the 17 next week. We get 20 cents. Or for the 17 and a half, we get 27 cents. And that's that difference of how much are we getting extrinsic value wise. So I could collect 20 cents, but I want to make 27 cents because we'll run the math again here. 27 cents, let's say I was collecting that each week, divided by 10, timesing by 365, is going to give me how much value I would make at the end of the year, $9.85 if I just sold that 17 and a half put repeatedly. And then we divide that by the total amount of risk that we have on, which is 17,500, because that's how selling a short put would be. I'd be on the hook for that value. And sorry, let's do it by 17.5. Knew there was something wrong. I would collect $9.85 if I sold that short put every week, and I'm risking $17.50, and that return is going to be 56% annualized return. There is some slight variation between the put side and the call side, and that is because of interest rates, right? I get paid if I have a short put, I don't make as much money, but I have more cash and I get some money for having cash in my account. That's why this return is only 56% compared to the 70% that we saw on the call. It's very, very difficult to make money off the arbitrage on either side. So you can pick whichever side you want. You could sell short puts and you could just sell that short put each week and make 56% return, or in an account that is registered, which is why I do it the way that I do. I just own the shares and then I just sell that in the money call and I roll it out each week. And what I'm looking for is, if the stock is 17 and a half, I'm looking to get at least 17 and a half cents per week. And then that'll give me a 52% annualized return. In this case, I was able to get a little bit more than that because I was able to roll some of them up to 50 cents. So I got paid to roll up that 50 cents. I hope that makes sense. Ryan, would you recommend opening America position? I don't make recommendations, as you know, Ryan, but I love Mara. It is one of the, if we just look at the chart, it is one of the positions it's a big Bitcoin player. They're a cryptocurrency. And I have been in trades in Mara that I got an extremely good deal on. So I can't even remember when I got into them. It wasn't this year, but I bought some for $10. I bought shares for, I don't think I ever paid more than $24. I think that's my highest cost basis. But I have specifically entered trades at multiple places on these charts. I'm just going to pick some random ones. Let's just say that these are the types of entries. And if you were to look at my returns over time using that strategy that I just showed you, the returns are quite good. So I'll just pull up a couple of these so I can tell you exactly what the return would be if I was closing today. So this one was opened August 28th of 2023. So that was here. So August 28th right here. That was one of the places that I purchased. And I was looking for opportunity, and that has returned since I opened it. It has returned an average compounding return of 40% per year. And the stock has not done all that much. You know, I paid originally, the stock was trading at $10.70 that day, and the stock is at $20. So in that time frame from August to now, my return if I was closing today would be 105%, which is the same as just buying stock outright. But that required an excellent entry. If I looked at a different position, this one, which was opened on July 24th, stock was at 1646. And how much is that worth today? Slightly hard to calculate on these particular ones, but stock is trading, that would be $17 if I'm over. Yeah, this one. So this, just looking at one of these, and this trade that I'm talking about has returned an average return of 36% per year. And I purchased that on July 24th for $16.46. So if we were to mark that on the chart, that was before that. That was July of, I purchased it here. And those are nearly identical returns. So on one of them, I've made a 105% return. On one of them, I've made a 96% return. If I had just purchased the stock on this, I would barely be up. Like, look at it, it's only trading right now at $20. So I would have made an appreciation. It's not like no appreciation, but it's trading right now at 19. Let's call it $20. 20, and I bought them for $16.46. So 20 minus 16.46 is 3.54, and we divided that by that 16.46, and the return on that capital is 21%. So if I had just purchased the stock at 21%, but instead of a 96% return, substantially different. All that money comes from the calls, and I don't really care when it runs up. I'm picking a midline. I'm just getting these shares, and I bought them all way back when, but they keep paying every single week. So why wouldn't I keep the position on? Every time I roll into a new position, I consider that my current position. I don't have a time machine. I can't go back, and I can't buy any of these shares at these prices. All I can do is today. So when I look at this particular position and I say, well, what if I was to sell the 17.5 call today and I was to buy 100 shares of Mara? Is this a good position? Well, it's got a 78% chance of making $34.50. I'm risking $1,715. That's a 70% return and has a 78% probability of profit. I like this type of trading, and it's why I continue to have it on. These are like that. I don't want to say they're like my bread and butter trades. It's they keep going. They can go down, but from a valuation standpoint, any trade that can pay me almost 2% a week is a pretty awesome strategy. It's very, very simple. I don't worry about this trade. Like, what happens if the stock drops $3? I'm still in my max profit zone, if that makes sense. Mike Mueller, good afternoon. Good to see you. I don't know why your comment, Nasir, was retracted, but please just ask again. Mike says, when VIX is low, up for interpretation, yes. Do you think there's any edge in buying VIX calls? I was thinking of buying calls when low, then if we get a spike, sell them and buy SVOL shares. Thoughts? I know that people do it. I think that you have to buy so many calls to make it worthwhile. I'm going to say that the Kirk Duplessis over at can somebody help me out? What is Kirk Duplessis' website? Options. Everybody has options in their name. He's been around forever though. He's got a great podcast. He's done tons of videos on like VIX hedging and stuff like that. He's kind of my go-to if I do want to put in VIX hedges. That's what I would look at. They have some very great videos on that. I would love for somebody to post some of those. I have them in my hedging section of my Discord, but I haven't actually done anything with them. I occasionally trade those trades. I find the returns are super small, so I don't know how you be able to scale those up. One of the problems is that all of those things start to eat up margin, and I'm like, as a Canadian, I'm fighting my margin all the time. So I don't do it. Definitely some traders do. They have to be pretty large volume for it to work. Easy Money is asking me about Adobe or Duolingo, so let's take a look at those. What do I have here? Let me pull up one of my, I'm gonna pull up Duolingo. I know you guys can't see that, but I'm going to have it here in a second, and then you'll be able to see what I'm looking at. So I'm using investing.com. This is the pro account. So fair value is sitting at 223, current value is at 319. These are the type of stocks, like if we, you know what I love about, and this is one of the things I love about investing.com. It's not even showing me the chart. Like this is the pro portion. It doesn't even show me the chart on here. When I go, I have to actually scroll down to see the chart. Because does it matter? Not really. You know what matters? This matters and this matters. That's what matters. This is the relevant data. We've got market range. We can see that the last year. Where has it been? We can see without looking at the chart. We can see what we're looking at. Analyst targets. This is what people think about it. And then the investing model. So we can see where we are. We're sitting in the middle of the row. We've got earnings coming up November 5th. This is what professional traders are looking at. Not looking at a chart at all. We see lots of bullish momentum. We see great performance, financial health. This is what's important to me. All of this stuff. Secondarily, we look at this chart that says, okay, here's the stock. Now, I still have to look at the stock. I look at the chart. It's not like I'm not. But 277. So even this fair market value of 223, we haven't actually seen that value in a very long time. So we would have to go back to further than the last year. And this is one of those situations where when I'm trading something like this and I'm looking at that fair value and thinking, okay, well, it could easily come down. How do I want to trade these? And what I do typically is I use limited loss trades. So let's take a look at Duolingo and we'll pull up a trade idea. I don't have a position on Duolingo. We don't have any earnings until November 5th. And we've got the chart here and we've got that low marking here at 256. So what I might do is I might look at this. This is 320. I might look to target some sort of trade that makes some money in this range. And I might want to, I don't care if it goes up. I can make lots of money holding long stocks when stocks go up. With my option trades, what I want to do is start to hedge my portfolio and I want to make some theta decay. So let's pull up the options and let's look at the strategy builder first. If we wanted to just go out, let's do a little bit of long duration trading first. We'll look at what happens if we want to put on a neutral trade, and it'll pull up some ideas. We can make potential profit of $2,000 on a collateral of $15,000. That's a huge amount of potential collateral. This is November 21st. It's after earnings. We don't have the earnings listed on here, which is a bit unusual, but that there is an earnings in here. So if I'm putting on new trades, what I want to do is make sure that I'm avoiding those earnings. And the earnings here are November 5th, not showing up in Moomoo. And again, this is where I use multiple resources all the time. So if I was doing something, I would want it to expire before October 31st. Now let's look at what our potential is. Doing a short strangle, the 275 put, the 370, and our potential profit of 1310. Let's go to this week's, or actually let's look at the chain on here. And what I'm going to do is I want to add up, we're going to look at October 31st, and I want to add two numbers together. I want to add the at the money put and call. So this is, let me just click on them because that's the easiest way to add. What if I was to sell a strangle here? What's the mid price right now? 45.9, right? So $46. So if I go back to this curve, or sorry, to the strategy builder, and if I put in money, $46, this is going to show us plus or minus. It's going to show where that's the expected move. That's the current expected move on Duolingo. And that strangle is just outside of it. So it's got a 71% chance of making $1,200 on a $16,000 in capital. What is the return on that in 24 days? Let's say it falls into max profit, 1215 divided by 15,940. So this is going to be a 7.6% return divided by 24 and then times that by 365. We can get an annualized return. 115% annualized return. That's why strangles are so lucrative. That's what the target is. That's a huge, huge target. How do we make this so that we don't have to put up that much capital and we have less risk on here? The return on capital is actually, we just did all this math. Let's divide that by that 365 and get back to, and then times this by 24. You can see this is the math I'm running right now, 7.6%. Moomoo calculates it already. Return on capital, 7.6%. Pretty amazing. Let's try to go to this chain. We're going to do the 270, 370, and then add some long wings to it. So let's clear this out. And we'll go to the table. We'll go to October 31st and we'll do the 370, 270, and then the where's my brain? 270, 370, 100 wide. And then the other thing to look at is like which side has more value in it. So I'm getting $7.10 for the call, and which is currently $50 above. And I'm only getting $4 and something for the put, which is $50 below. So that leads me to believe that there is upside potential here. There's more value. The skew is to the call side. There's a call side skew, which means that I might want to place a bullish trade. Or what I might want to do is buy something with some of this money. What if I just bought like a little cheap spread in here? I mean, I could easily buy something in here. And what if I did that? What if I built out my my trade in that way? And let's take a look at this curve. So now I have a wider spread. That's 388 is my break even. I have a larger max profit. Probability of profit 71%. My delta is slightly short actually, which is amazing. My theta is $63 a day. Still unlimited max loss. So how do I define that risk? Well, let's go out to that chain again. I can't do it because I've gotten too complex here on the call side. I've added that little spread in here, but that definitely increases my probability and moves this profit trend over. So whenever I want to build something out where I want to have a little bit of upside, especially with this is a short delta play, but then if it does move up, it's moving into my profit 10. I love that. I love that. Break even's at 388. Let's go to the chart here. Let's mark some lines on. 388 is still way down here. And we did see some big spikes on the last earnings, but that last earnings was August 6th. So, and our next earnings is until November, right? That's what we're looking at. Just want to just check one more time. Yeah, November 5th. So that is the upside. And then on the downside, I'm collecting. So if we go to the options tab again, the break even 261. So I would love to see I would love to see if Mumu's watching and looking for things to add to. I would love to see that the break evens appeared on this. That's an awesome trade if you've got the capital for it. Can we define that risk? Absolutely. All we have to do is buy some wings. So you can go out here and you can buy some cheap wings, you know, the 5 cents. You should be able to buy some of these. These are showing the bids at buying the 235 for October 31st. That's one way to buy the wings. And you can just buy those. Can't do a 6-legged trade in Mumu, but we could just delete some of these. And then how much would the 335, sorry, the 235 cost? So if I was to define the risk, I was to buy this, and then I was going to go to the call side, and I'm going to buy, you know, the 400s. Whoa, those are expensive. Boy, there's lots of upside on this. I would be looking at bullish positions for sure on this type of trade. And now the max loss is now 3,892. Max profit 606. Probability of profit is dropped 66%. And if we look at the curve, you're going to see what it looks like. This is still a slightly short delta trade, just ever so slightly, 0.03%. Theta is $17 instead of, what was it before? $63. And that break even is 376. This one's 263. So it barely adjusted the break even on the downside. I would be concerned about whether or not we see an up move here outside of this range, especially if I brought that level down to 376. You know, it doesn't seem like much until the stock really starts to rally. If you want a super bullish trade, let's just set up something super bullish. Let's go. I want to make some money I think Duolingo is going to go up. One of the trades I like to do, which is totally fun, is to sell some out of the money calls, and I'll do like 2 of those, and then I'll buy some longer duration long calls. And this everything costs money. You want to make money, you gotta there's money to money. So this is going to cost mid price of $13,000. And if we look at that curve, this is a $13,000 trade. Say the stock didn't move at all at expiration over the next 24 days, then this trade makes $1,500, which is pretty awesome. So it makes $1,500 just sitting there. It's got a max profit the max profit is technically unlimited. If you were to zoom out, it gives you, if the stock went to $600, you can make 24,000. This is definitely not like 100% type trade. You're not going to make 100% return, but what it's doing is it's generating a ton of theta decay, $23 a day. It has limited downside risk. We could do less downside risk by buying a call that's closer to the money. So we can buy a more expensive call. Say we bought, and you can do this however you want. This trade is $7,000 now. That's the max we could lose if Duolingo went down. If it stays where it is, it still makes $1,400. But when we zoom out, this trade is not going to make that 24,000. If it was to go to 600, it would only make $1,500 or $15,000 P&L. So that would be a 200% return, bigger percentage return. Still, by doing these ratios, can be a very cheap way to get into it. If you go too high, then it becomes a valley of death. So it really depends on where you are. Where do you think the stock is going to be? And this is the cool thing about options trading, is we get to just adjust these. This is a trade that makes money between 301 and 380. It's an extremely wide range over the next 24 days. Could make up to $3,000. It only costs $3,900 to get into it. So if I want less risk to the downside, I sell lower calls. So it's moved over. Now this is 272 to 360. And this is where if I'm now buy these lower calls, then I can adjust my profit profile. This is like a trade that I like to do if I'm really bullish on a stock. Duolingo's at 320, and I think it's going to go up, and I want to have some long deltas. This has got a positive delta of 31. It's got a theta decay. It makes 20 bucks a day just for holding the trade. It's got a max loss of $5,300. It's got a 66% probability of profit. They're pretty amazing. Options Alpha, thanks Mike. That's what I was thinking of. Kirk Duplessis over at Options Alpha, excellent content. If you guys get a chance to listen to his stuff, it's great. He's got some great VIX hedging strategies. Let's look at Adobe. These are the type of trades when I see like that kind of call skew, then I like a trade like this that just makes money if the stock doesn't go up. Like that profit tent here to make $2,800 on a $5,700 risk is pretty great. Now the other thing you can do is buy a put as well, so that would protect the downside. But this is pretty good. 295. I might want to be a little bit lower than that. This is the 320s. Maybe we do like the 310s. Valley of death there. So you just keep playing with it until you get yourself in a position where you're like, I don't mind making $1,700 if the stock drops $10. And my max loss on this though is 8,500. So there's this where you've got more risk on by getting further and depleting that profit tent for trying to move this over too much. That's why those initial positions that I showed you were pretty good. You still can make a very decent amount of money selling just the condor, and it's why condors are like a stock standard position. So yeah, that's I think we've beaten that with a dead horse. Yeah. Let's go on to Adobe. That was the question, right? Adobe. Adobe trading at 347. Again, let's look at the table. Let's look out at October 31st, 24 days away. We've got the at the money, which is the 50s. We've got $11.70 or $12.60, so fairly even there. How do we make money off of this? Selling a strangle. Let's see if we can set up what let's see if we can set up the condor that the strategy builder is going to pull. So we've got Adobe. What I'm doing is I'm looking at the 27 delta. So 23, it's going to be this strike right here. And then how wide did we go? That's $10 wide. So 375, 380. So let's look at this curve. So this is going to give me a 64% probability of profit, a little bit low. Max profit is 259. Max loss is 741. Pretty good. It's got a positive theta of $7 a day. It's got a little bit of Vega, short Vega in here, which is because we're premium selling, and it's got a defined risk. In these cases, let's go to the strategy builder. So this one was the 310, 320, 375, 385. Let's just go to the strategy builder and see which one it recommends for condor. Short condor here. So it's looking at, wow, quite a bit wider actually. Quite a bit narrower. That seems like a lot. Let's bump this up and see if that adjusts in. 320, 340. Yeah, pretty interesting. So just change that expected move, and we can figure out that expected move just by going to the chain and looking at that strangle price. So if we look at the table and we see the October 31st, we can see 1175 and 1260. So we're at basically $22 potential move. So if we go to it's quite a bit of expected move actually. And then there's the short condor. So it did the 305, 335, 365, 395, and that making $970 for 2029 55% probability of profit. If I was going to trade a trade like this, I would definitely be putting myself in a position where I want to adjust it into a butterfly if we started to see drift in one way or the other. And if I clicked on the trade button, we would see the break evens 325, 374. So we'll go back to the chart and I would just mark those on there. I would just say 375. And what was the other one? 344. And we're right, it can't be that low, I don't think. 374, 325, 374. It's funny how you do this stuff all the time and then you're like live streaming and all of a sudden your brain is just melting. That's Iron Condor. It definitely is trading in a range depending on whether or not we're going to break out or not. When are earnings? Let's take a look at that. I like that trade quite a bit. And this is where fair value 466. Stock's trading at 347. Now it's investing.com has had this high fair market value for quite a while. 466 is way up here. So in this case, what you might want to do if you're paranoid about it going up is what we do is we just buy a tighter call here. We don't have to do that. We can put all the risk to one side. And then the other thing we can do is sell some more puts to calls. Now it's got no upside risk. We've created like a Jade Lizard type of strategy, but it was with limited loss. This has got a credit of 1250. It's got a max loss of 47.43. And then it's got a probability of profit of 72. If I really wanted to amp this up, what I could do is I could buy these puts on a different expiration. I could buy them like November. And by doing that, by doing that spread, what that does is it increases, if the volatility increases to the downside, I only collect $9 on this. But if the volatility increases to the downside, there's potential of this extending out and giving me a lower break even. And that the max risk on this is $5,000. So again, fairly big contracts. And I could tighten that risk up by buying a higher put, doing maybe like the 310. But what I'm doing is I'm also creating myself a potential loss on the upside, depending on what I want to do. In this case, I'm collecting $8 and I've got a $10 wide spread at that 365, 375. But my break even's 326, 373. So if we look at this, very, very similar break evens and very, very low upside risk if it was going up. And then 323. That's how I like to trade. I like to put positions on like this, not just do the standard Condor, but do a position where I'm collecting $800 and then we'll go from there. If that makes sense. Credit is always nice to collect credit. Okay, is there any other questions? Buying synthetic position with a protective put is significantly cheaper than buying leaps on the same expiration day. What's the gotcha? Let's take a look at that. So do you have an example, Mike? What do you want to see? How many, what particular position do you want to look at? Let's go to the strategy builder. Let's look at Adobe. So if we're going to buy a synthetic stock position, say I go out, I want to sell a put and buy a call. It's going to give me a synthetic stock. People are wondering, what does that look like? This is what it looks like. It has a profit profile that is basically 100 delta. So is it showing my delta here? Yeah, exactly 100 delta. So 1.000. Theta decay is very minimal, 0.03. So I'm paying a little bit of money to hold this position. Easy Money, thank you very much. You're very welcome, Easy Money. I'm glad you enjoyed. So buying a synthetic position, I'm just looking at Mike's question. Buying a synthetic position with a protective put is significantly cheaper than buying a leaps on the same expiration date. What's the gotcha? Okay, so we'll go to the table and we'll buy this protective put. Let's say we buy the 325. And so we would pay $2,300 for this and we would have the curve. if the stock trades at 348, which is where it is now, we will at expiration, 348, we would be down. I'm just trying to figure out where we would, how much we would be down. Oh, come on, give me that. We would be down $2,000 if the stock doesn't move from the current level. So that would have a cost of $2,000. We get a delta right now of 0.69. So it's the same as buying 69 shares of stock. And then so he's saying buy an 80 delta call, and we're looking at, compare that to a long at the money, short at the money put, and offsetting long protective put. Yeah, so choose Chewy. Okay, well, I'll take, yeah, sure. Let's just look at Chewy. Let's just do Chewy, and we'll just walk it all through. It's good to have these questions, and thanks, Mike, for asking such complex questions. I do appreciate that. It's that's what I like to do, is analyze this kind of stuff. So if we're looking out, say we wanted to get a leap trade, so we're going far out, like it's got to be longer than a year. So let's go January of next year. I want a long position. So the synthetic long position is at the money. Stock's trading at 37.50. So I would buy the call, sell the short put, and then we're looking at 80 delta. So I'm looking for delta here. Why is it not showing up? The delta 80. Okay, so the 80 delta is the 30 strike. So that's the one I would buy to give me protective put. So let's look at the curve. Curve is 500. The price right now is $518 debit, and the max loss is showing at 13.15, and that's because the stock could drop down and then have a protection there of 13.15. Now, $500. Okay, that makes sense. So that's one. We're going to look at that. I'm going to just screen grab this. It's maybe one of those questions I can't actually answer until I actually take a look at it. So if we were to just switch this 30 put to a call and then delete these other two, this is going to cost $12.50 to buy this. So it is cheaper by $100 to buy the call. And what is the question? It's actually cheaper to do the call than it was from a risk profile, because the risk is $1,270. So this is less risky. Buy your long protective put so that all three legs are right around 80 delta. Oh, I see. All three legs are at 80 delta. Okay, let's try that again. So let's convert this back, and then we'll go to the chain, and then we're gonna sell that and buy the call. 37.50, and this is giving, yeah, this is 80 delta. Buying the put, so that's 80 delta, but the total risk on this, the risk is pretty similar. I mean, we're talking about expiration P&L here. Expiration P&L is showing at 12.64 right now. That's what the marked price is, and that's giving an 80 delta position. Otherwise, if we delete these off and we just buy the call, which is an 80 delta call, so this is giving us the same 80 delta position, and the max expiration P&L is 12.45. They're the same. There's no difference between these two because the positions are theoretically the same, you know. And this is where the options can be. And I know we think about like arbitrage, like, well, what could happen? This one, you're out of pocket 12.45 right now today. But on the other trade, if we were to do that, we're just out of pocket a little bit less money, but the max profit or the max loss is still the same. So when we go back, we're going to sell, and then we're going to buy. Now, one of the things, if I was looking at this and I was saying, okay, how do I maximize this return? If I want this position, 79 delta, how do I increase this? What I do is I wouldn't sell this short put at this date. You're only getting 635 bucks for this short put that's way out, January 15th and January of 2017. What if you sold it way tighter? Like, what if you sold this at how much do you get for the December 19th? That's the nice thing, as opposed to just the leap. This is where you're getting 300 bucks for that. This one has a way better curve. And the reason for that is because it's still got delta. Like, look, this has got an 86 delta. It's actually more delta. It costs you slightly more money, but the short put, this 37 put, has $300 in extrinsic value as opposed to $600 in extrinsic value. If you roll this a couple of times, then you only have to do 73 days twice to make the same amount of credit that you initially collected off of the other one. This is where complexity adds. If you go to 45 days, it might even be better. Let's look at the table here. So I rarely, if I'm doing a synthetic position, I rarely am doing the same dates. Let's look at November 21st. Yeah, this is getting $200 for the 45 day. So remember the January one, this short put is only worth $645 total. That's the max profit on it. Selling that trade is at $645. When you take 645 and then you divide it by 465 days, the theta decay is terrible. It's $1.38 per day. Whereas if you look at the November position, and this one right here, this 3750 is making 198 divided by 45 days. So instead of $1.38 per day, it's making $4.40 per day. It's this trade is significantly better than a leap. And it's why I don't actually buy leaps. Like, if I want this type of trade, and I'm just like looking at Chewy, and I want high delta 87 and my positive theta by a little bit. It would be interesting to see, is this one positive theta? It's probably not. Yeah, this is negative theta. So this trade loses money daily, and this trade is making money daily. And is the max risk that much more? Let's, the max risk, could you lose more? Absolutely. We could lose $1,850. So it's increasing the amount of risk by a little bit, but we're trading off by having more theta decay, or positive theta decay. Hopefully that helps. Synthetic cost me much less than the leaps. Well, no, I understand that it costs less. It's $500. It costs $500 rather than $1,300, but there's still risk. That's synthetic, because the problem is you might have to pay out the short. If you say the stock drops to $30, let's just say it's trading rated $30. Well, then at the end of the trade, you're gonna have to pay $750 to close it, because you've got a protective put at $30, and you have a short 37.50 call put. And if it's trading at $30, you're going to have to pay that $750 on top of the $500 that you entered today. So from a out-of-pocket expense today, yes, $500 for that long synthetic position compared to $1,200 for the leap, but that $750 is going to be owed at a later time. The real benefit with the synthetic is that when you pair the short put and the long call at different dates. Let's take a look just at those. Don't include the protective put, which we know is going to cost some money if we delete that. If we just look at this trade in relation to this one, has a max loss of $43.95, and it has positive theta decay of $1 a day. 55% probability of profit. So for the increased potential max loss of 43.95 relative to 4,000, so I'm increasing my risk by $300 to have positive theta decay as opposed to negative theta decay, I will take that anytime. Probability of profit on this trade is only 38%, whereas probability of profit on this trade is 55%. So considerably higher probability of profit. That's just looking at the synthetic portion, not the long put. And obviously the long put being purchased way out of that expiration date is the best way to do it. I don't know what dates, but I would appreciate it if you send me an email. That would be fantastic. I would love to compare more as to how that works. But that, from a risk perspective, I don't think you're saving anymore. You're just out of pocket less right now. If that makes sense. Okay, you follow me. Okay, good. That's awesome. That's my thought. There is no, I have never seen it. I have never seen a position where I was like, oh, I can make more. Even those trades that I made, that zero risk trades, remember the zero risk is that I'm going to make a little amount of money. And that little amount of money, although there's no risk to my capital, is that it makes less than if I just had it in a savings account, if I just made 4% return. So there is some risk in that I make smaller than a 4% return. If you guys haven't watched that video, you should check it out. Zero loss trades. It's pretty cool, especially in this market environment. If you're if you're a retiree and you're like, what do I do with my money? And you're like, how do I do this? And you want to make potentially bigger return than a cash, just cash sitting in like bill, with no risk, then that is an awesome trade and still collect the dividends. It's pretty great. Pretty awesome. And Dark Horse Workshop is here. That is awesome. Thanks for joining, Richard. I'm just about to end, but because I'm all talked out, we did some strategies. And Richard, I'm hoping to see you on Friday. We're going to be down on the coast. Anybody else in Vancouver this weekend? I'm going to be down there for Thanksgiving. Trading is going to be light in my chat room on Friday because I'm going to be on the road. And as always, I've got my members only stream on Thursday. So you guys will see that, see all the awesome positions I have on. It's been an absolute killer week. And we've been putting on tons of trades right now because it's just like, we're just pumping into the end of the year. We're going to make a ton of money as per usual. Thanks so much, everybody. Let's get rich together. Talk soon. Bye.